and welcome to the Mutual Fund Show. My name is Neeraj Shah. If you are indeed a mutual fund investor, current or potential, then the only thing that would be at the top of your mind is that what should you do with your current SIP? Or if you want to start an SIP, is this the right time to start an SIP? I know the usual answer is the right time to start any kind of investment is now. The question only is, can that happen at the current point of time, or would you want to take some time to try and figure out whether this is the right time or should you take some other time? That's the big question on the minds of almost every mutual fund investor right now, especially the one who's not seen previous down cycles and is probably depending on the advice of either the current advisors that he has or he or she has, or is looking at shows like this. Well, we'll try and give you some answers to that. Vijai Mantri, Chief Investment Strategist and founder at JRL Money, joins us right now on the show. Vijay, so good having you. Thanks much for taking the time out. Now, let's cut to the chase straight away. Compare this to maybe a past instance and try and tell us why is it that it's a good idea to continue the SIP. I know when you're here, you would be coming with that advice that it's a good idea to continue the SIP. My question is why?
So let's not presume that I'm going to say that. Okay? So the most important thing to look at data. What happened in past and what is going to happen in future. And I believe there are two very important laws in the finance. One is reversal to mean. So if anything which has gone up will come down, anything is going down ultimately going to come up. That's the one part. The second part is one of the worst way to look at investing is to look at immediate past return. If immediate past returns are good, then one tempted to look at investing in that asset category. If immediate past returns are bad, then one look at avoiding that asset category. One simple illustration to look at is just look at GSEC return right now. Most GSEC funds are in double digit. So one of the best performing asset category over the last 1 year. But 1 year back, all GSEC funds were in negative territory. So if anybody who told you 1.5 year back that please look at investing in GSEC fund or long-term dated fund, nobody would have believed it. Similarly, if you remember our show, we did a very interesting show few years back where we said, suppose you have EMI and SIP, and suppose you set a target for SIP, and whenever the target hits, you take money out from SIP and invest that money to repay your housing loan. We got trolled on social media. People said that it doesn't make any sense, one should stay invested in SIP. If anybody who listened to that at that time and would have acted, he would have been much happier today. So in my sense is that one need to examine data. So let's examine what happened in 2008. 2008 where the market Nifty touched 6,000 and then it fell to less than 3,000 in October 2018, rose again and then fell again in March 2009. So if you look at data of these around 15-16 months, it will give you very interesting inputs to you when you look at SIP. So if you look at Jan 2008, Nifty was at 6,000 plus number. And suppose you started SIP at the peak of Nifty in January 2008. By October 2008, Nifty is almost down 50% from its peak. Your investment is showing 32% negative return at that particular moment. We haven't seen that kind of negative return yet on SIP. But suppose you stayed invested, the numbers look much worse in Jan 2009 where the Nifty has touched 2683 and your SIP returns are negative 37%. But look at April 2009 number. Nifty is almost at the same number and perhaps lower than October 2008 number. But your negative return has come down from 37% to 31%. And May 2009, Nifty has gone up to 3654. Your returns, negative return is just 3%. And in June 2009, that is almost 18 months after you started your SIP, Nifty is around 1/3 down from its peak. So it is down more than 30%. But your SIP return is up 19%. So this is what happened in 2008, where the market has gone through deep and immediate correction and then bounced back. Not bounced back fully, but it covered half of its losses. But SIP actually started delivering a positive return. So this is what we have witnessed in 2008. So if somebody has stopped SIP in October 2008, then he has participated in all the volatility in the downward journey, but is not participated when the gains start accruing to you. So this is the story or 2008.
Yeah, and for a lot of you who might not, just if you look at the two plates that we showed, look at the first number, which is the value of the Nifty in Jan 2008, which was 6144. Remember this value, and now look at the last value, which is June 2009. The value is 4530. 26% fall in the index. The SIP return at the lowest, the last number on your screen at the end of June 2009 was 18% positive. So you actually made 19% returns, while the index fell about 26%. Now, you might argue that these are extreme scenarios, and we're taking one example like 2008, but that was probably the most stark fall that we saw, and yet SIPs provided returns, which shows, and the numbers may vary, Vijay, but I think other examples as well, if you probably look at maybe an SIP that somebody would have done in 2001 to 2007, 8, or in 2013 as well, the numbers may not look similar, but they may rhyme.
The numbers look actually identical, almost identical when you look at year 2000. Instead of 18 months, and sometime it is 22 months, sometime it's 24 months. But one thing comes out very clearly: the deeper is the correction, the longer is the market remain in downward journey, better is the return in SIP. Now, this is very easy for me to communicate, because I'm seeing market from 92.
Yeah.
So I've seen 92 to 2004. 12-year, absolutely no return in the market, absolutely. I've seen year 2000, I've seen 2008, I've seen 2013. But it is not very easy for new investor, where large chunk of money has come in the mutual fund industry in post-2016. So I give some numbers to you. If you look at 2004 to 2014, in a 10-year period, on an average per day basis, mutual fund industry got 35 crore inflows for a 10-year period. Post 2014, the per day inflow is 400 crore rupees. So it is almost 11 to 12 times more in last 5-6 years. And I don't think many of these investors has witnessed this kind of challenges. So, and now on the top up, we have direct plan as well, where investor might have gone directly and now they are struggling. So I'm not even saying one should not go for direct plan. That is not the intention, but I'm saying I'm making a general statement. Okay.
Sure.
The second thing to keep in mind to keep in mind is that when you look at return from SIP or return from equity market, it come through the phase of volatility. Now, what drives your investor behavior? When you look at the numbers, which part of your body tells you the returns are negative? It is your eyes and brains tells you returns are negative. But in equity market, one should not listen to brain too much. It is the stomach which should drive your investment outlook. So I'll make an analogy. What drive food habits? It is not your liver, it is not your intestine. What drive food habits is tongue. And if you're driven by tongue, then you eat something which you shouldn't be eating. Okay. Similarly.
Very cool. But yeah, I think the larger point is that you should have the gumption to hold on to the investments during volatile times, because that would probably lead to multifold gains. Now, Vijay, the one thing is, people will say, "Yaar, ye to past dikha diya. What about the future?" Let's try and put some numbers from the current scenario. What could happen if the index were to gain XYZ, ABC, and therefore what could happen to SIP investments if there is a calculation to do that?
I think we should look at on index, we haven't seen that kind of correction. The top line index is just down 9%, 10%, so there is nothing. And that is not the way the customer's pain is. The customer's pain is more on the mid cap and a small cap. So right thing to look at, perhaps let's look at mid cap as indices and see what happened to mid-cap indices from the peak of January 2018. Last peak was in Jan 2008, then the peak was in Jan 2018. So if you look at data from Jan 2018 till say August 2019, we have almost like 17-month period. The Nifty mid-cap indices are down around 26-27% from its peak. The SIP returns are not down as much.
Yeah, 13.5%.
So that is a number as on date. There is a SIP number for mid and a small cap fund. Now let's see what happened from today.
Sure.
So let's try to peep into future. And let's assume that the market continue to have the same slide. Market continue to go down from here till next 2 years.
This is one assumption.
That's one assumption. Let's assume that market is going to go down, say, 2.5% from these levels. So we built a projection from August 2019 to August 2021. For a 24-month period from these level, the Nifty mid-cap indices continue to go down 2.5% on an average.
Okay.
So number you see is that in August 2000, your SIP returns are negative 13%. By August 2020, the returns are negative 28%. That is just 1 year from now.
Yes.
But now assume one more year from these level and just look at the data on August 2021.
Yeah.
So if you project for next 2 years and you continue in your SIP, your 4,40,000 which you invested is showing a value of 2,76,000. So your portfolio is down around 38%. But the broad Nifty indices are down around 50% plus 55-60% approximately. So that is a kind of volatility you would see in your portfolio. Suppose you see market continue to go down.
Okay, I just want to come in here. Viewers, remember, we don't have the number out there, but essentially in this math, from August 19 to August 21, August 2019 to August 2021, if we assume a 2.5% drop, then the value of the index would have fallen by over 55%. And the number that we're showing, the SIP return, or the number that JRL Money is showing as of August 2021 is a negative 37.3%.
Yes. So we assume the market will continue to go down 2.5% per annum. So,
Yeah.
So this is what we are seeing will happen and potentially can happen to the customer's portfolio.
Right.
But the market, if it goes down, it is coming. It is gone down. It has come down from peak of 21,000 in Nifty to around 15,000 levels, around 26, 27, 28% downward. And from here, suppose you look for next 2 years. Again, we are seeing drop of 2.5% per annum. But now let's assume that it then start going up 2% per annum from the bottom level.
2% per month.
Per month from that level. So what you will see in next 1 year plus kind of thing, the return which you were 37% negative, by November 2022, your return has become only 8% negative. Okay. So we haven't reached the level where we started, not even the midway, but your SIP's return start dropping, negative returns start dropping by November 2022. But suppose you go further and look at by February 2000, let's look at, for instance, May 2023, your SIP is actually in positive territory. And by February 2024, your SIP is showing you 22% IRR, where the index is still at the much lower level from what from where we started.
Or almost at the same level, right? 15,755. I think by August 2019 it reached that. But you're not around those levels.
So we started 21,000 level.
Sure. Okay.
So we started 21,000 level. Nifty mid cap is right now 15,000 level. It corrects 2.5% per annum. Then again it rises by 2% per annum and come back to 15,000 level.
Yeah, sure.
So starting point has been 21,000. Still it is 15,000 level. So almost 20% plus down, but SIP is showing 22% positive return. So that is the beauty of SIP.
Well, that's quite a stunning statistic. And again, for a lot of people who would argue that why is it that the index would rise 2% or fall 2.5%. I think historically there have been some instances wherein the extent of the correction would have been that much, which is why these are safe assumptions to make. For hypothesis, this is not what will happen, but assuming that it happens, these are not unrealistic assumptions.
See, the market from the peak, if you look at Nifty, it has gone down around 58%. The mid and small cap indices have seen much deeper correction. They have gone down like 60% plus. So we have taken those numbers, okay? Even it goes down further by a few more percentage, it doesn't matter, because from 60% down to 65% down, it can happen. But the deeper it goes, the faster is the recovery and the more money actually you make. You make more money in SIP. You can only make money in SIP if the market goes down much deeper. You make more money. The market just can't go in upward trajectory. So let the market keep going down. This is what we have seen happen. It may not go down exactly by 2.5% per month. In some month it may rise, some month we'll see more deeper correction. But let's assume that it fall as much as it's fallen historically. And it take much longer than what we have seen in past. Even in that situation, even the market doesn't come to 21,000 level, your SIP is in positive. But suppose market come back to 21,000 level.
Yeah, the peak.
The peak.
Okay,
suppose
so right now we've spoken about just coming back to 15,000 odd by that 2% level. 2%. But what if it were to go to historic peaks?
If market come back to 21,000, the way it is fallen 2.5% per month from now and again rise 2% and come back to 21,000 Nifty mid cap, your SIP return, IRR return on SIP is 12% per annum. So at 21,000 you started, mid-cap index has gone down below 10,000, rose again to 15,000, you're making 22% absolute return, comes back to 21,000, starting point and end point is same, but because of this kind of journey, your SIP is showing you 12% XIRR.
Now, that's quite stunning, by the way. So keep in mind that if we were to move to the point where the Nifty Mid-Cap 100 Index peaked into the December 2017, the returns as of July 2025, the SIP return would be 61%. The index would just have come back to the December 2017 levels. That's it. The index hasn't done too much, but if you are an SIP investor, your SIP returns would be 61%. That tells you a story, doesn't it? Vijay, great numbers, good from a perspective of somebody who has an SIP, is continuing, etc., etc. A lot of people would want to know that, hey, I've been in the market for some time, I've observed the markets, but because of the current spate of news flow, I've not gone out and invested. Now, I've heard a lot of people on programs like these or market link programs say that this is a good time to start investing. I want to start investing, but the markets may continue to go down or go up, etc., and all of that. What happens to my returns if I'm starting my SIP today, as of this moment? Any math for that?
If you haven't done SIP now, I think you should do it now. So let's assume we take Nifty mid cap. Right now, Nifty mid cap is at 15,000 level. Again, we take the same number. It is going down 2.5% per annum.
For 2 years.
For 2 years, like same number. Your starting point is not 21,000 Nifty. Your starting point is 15,000 Nifty level. It goes down for next 2 years, 2.5% per annum. It comes back again. And again, suppose it hit just 15,000 level only, not even 21,000. Your XIRR on SIP is 14% per annum.
Okay.
XIRR on SIP is 14% from 15,000 to 15,000.
Okay. So, well, in which case it almost seems to be a scenario that you're painting that if you are indeed an SIP investor, maybe, just maybe, you should actually be happy that the markets are giving you a longer lull, either a longer lull or going down over a period of time, because it allows you to buy those units at a cheaper price. Everybody knows that math, but nobody would quite figure out that this is the extent of gains that can come in.
The reason is very simple, is that if you look at mathematics, how the mathematics works. So in one of your program, I took an illustration of gold. So suppose you take gold as illustration. What people end up buying is fixed quantity, but if you buy fixed price, so let me give you an illustration. Suppose I did some number a few months back. You buy 10 gram of gold on every Dhanteras. For 20 years, suppose you bought. So you bought 200 gram of gold. The average price of buying 10 gram every year from 4,000 rupees, 10 gram to 32, 33, at that time was around 16,000 rupees per 10 gram. That is average cost. But suppose instead of buying a fixed quantity, you said, I'll buy a fixed price. So you said, I'll buy 16,000 rupees per month gold. Then the average cost come down much more dramatically. Instead of 200 gram, you end up buying 320 gram. And the logic is very simple. When you buy a fixed quantity, when the prices are 4,000 rupees for 10 gram, you are investing only 4,000 rupees. When the prices are 32,000 rupees for a 10 gram, you are investing 32,000 rupees. But when you buy a fixed amount, suppose you buy fixed amount, then at 16,000 rupees you're investing. When the prices are 4,000, you're buying 40 gram. When the prices are 32,000, you're just buying 5 gram. So that is the magic which works in SIP. In SIP, if you buy through fixed amount, the average cost of that will be much lower than buying fixed quantity. So if the market remain at the same level, it comes back to the same level, you are in money in SIP. This is a math many people don't know, many people can't comprehend, many people has not been explained, but this logic works wonderfully well in SIP.
Okay. Great. So, well, that's the sum and substance, really. If you are looking at the markets right now and feeling that your returns may not come in commensurate to the kind of money that you're putting in, well, if you're an SIP investor, then it will actually work very, very well for you. So that's the sum and substance of SIPs. Now, before we wrap this show, Vijay, thank you so much for this knowledge. But before we wrap the show, it's also pertinent to talk about some of the current issues at hand. And we've spoken at length about debt markets and all of that, so I want to get into that. But there are a couple of NFOs that are currently on right now. Have you had a chance to look at them? The Motilal Oswal team was here the other day. They were talking about launch of some passive funds. Any thoughts there? There is also, I think, a Sundaram NFO which is open right now. Any thoughts on that?
Definitely, we track most NFOs because that is part of a job to track. So Sundaram, they already have schemes, some schemes are doing well, some schemes are not doing too well. So in multi-cap category, there are open-ended fund available in the market. Suppose someone want to invest, the better opportunity to invest in those kind of fund. On passive investing, the jury is out. I'm not fully convinced. I don't have enough data available to suggest that in Indian market, the passive fund will continue to do well. I don't agree with that, and we need to see the data. I have done my own studies, and my studies prove that open-ended mutual fund has added significant alpha to the customer. I tell you, the challenges with many of these studies are couple. One is that when you look at these numbers, they are, say, for instance, 40 fund in large cap category for argument's sake. Now, some guys is following Nifty 50 as a benchmark, some guys following Sensex as a benchmark, some guys following Nifty 100 or BSE 100 as a benchmark. But for the studies of these funds, one benchmark is picked, and the comparison is done with that benchmark. That fund house is not even following that benchmark. And some of these benchmarks were not in existence 10 years back. So I've seen some studies where the benchmark was not in existence. When I say my benchmark is Sensex or Nifty, how do you compare me with the BSE 100? It's not possible. The second point is that the comparison is made with TRI, Total Return Index. My question is that which customer get Total Return Index? Because either you invest in ETF or you invest in index fund. Index fund, there's impact cost, there's a fund running cost. In ETF, there's a brokerage, there's a buy and sell spread. I don't think all these things are captured when comparison is made.
Okay.
So if you factor the right thing to do, for instance, if you want to do comparison, take Nifty mutual fund, take Nifty funds, and do comparison of Nifty funds with the open-ended mutual fund in large cap category. Then the game is there.
Okay. So you would not be a proponent of the passive funds that have been launched?
Not yet. If I see data, if I'm convinced that this is a trend which is emerging very clearly, today I don't see that.
The argument is that some of the large cap funds have not been able to beat their benchmarks in the recent past. 50% of them have not been able to do that. So why invest money in these high cost funds on the large cap side? Might as well invest passive.
Actually, it's very interesting. The argument is to me, looks completely lopsided. Why large cap has not done well? Because a large cap portfolio will have 40, 50 stocks.
Sure.
And if you look at the current market, it's driven by just few stocks. So
yes.
A mutual fund can't have 12 stock, 15 stock. The gain in the market has come through these stocks only. So at any given point of time when you see the data, these kind of conclusion may come. But let's see, 1.5 year down the line, 2 year down the line, when before the show you were saying, that bottom 30 index of Nifty may outperform top 10. If that trend comes, then definitely you will see outperformance coming back again.
Yeah, well, it's a story that we put out today. History suggests that whenever the peak polarization happens, then the bottom 30 tend to do
Absolutely.
well. But let's wait and watch if that happens. But so viewers, for all of you who are wondering, the couple of NFOs open, whether or not to invest into, Vijay Mantri believes he is not in favor of the passive funds that are on offer for the current time from the Motilal Oswal stable, but some of the other houses also have their own passive funds or pseudo-passive funds that have been launched. Vijay Mantri is not in favor of that. He believes that active fund management might still give you better returns. Vijay, take a moment to thank you for joining in today on the Mutual Fund Show and giving us your thoughts. Thanks so much.
Thank you very much.
And viewers, thanks for tuning in to this leg of the Mutual Fund Show.